Investing can be an intimidating endeavor, especially for beginners. The world of stocks, bonds, and mutual funds is filled with jargon and complex concepts that can make it difficult for newcomers to navigate. However, understanding key financial terms is essential to making informed investment decisions and building a strong foundation for your financial future. In this video, we will explore the top 10 terms every beginner investor should understand. 1. Stocks, equities. At the heart of investing is the concept of stocks, also known as equities. A stock represents ownership in a company. When you buy shares of a company's stock, you're purchasing a small ownership stake in that business. Investors who own stocks benefit from the company's success in the form of price appreciation, capital gains, and dividends, payments made to shareholders from the company's profits. Why it's important? Stocks are one of the most common types of investments. They offer the potential for high returns but also come with higher risk due to market volatility. Understanding how stocks work is essential for any investor looking to build wealth over time. Key point: stock prices fluctuate based on market conditions, company performance, and economic factors. 2. Bonds. A bond is essentially a loan that you give to a company, government, or other entity in exchange for regular interest payments and the return of the principal at a set maturity date. Bonds are often seen as a safer investment than stocks, as they typically provide a steady income stream and less price volatility. Why it's important? Bonds are a common part of investment portfolios, especially for conservative investors. They tend to offer lower returns than stocks but are considered less risky. Bonds can help balance out the more volatile nature of stocks in a diversified portfolio. Key point: bonds are classified by their credit rating, e.g., investment grade or junk bonds. The lower the credit rating, the higher the potential return, but also the higher the risk. 3. Mutual funds. A mutual fund is a pool of money from many investors that is managed by a professional fund manager. The fund invests in a diversified portfolio of stocks, bonds, or other securities. Mutual funds provide investors with diversification, meaning their money is spread across multiple investments, reducing the risk of any single investment performing poorly. Why it's important? Mutual funds are an excellent way for beginner investors to get exposure to a variety of asset classes without having to pick individual stocks or bonds. They are also managed by professionals, so investors don't have to spend time researching individual investments. Key point: mutual funds come in different types, including index funds, actively managed funds, and target date funds, each with its own investment strategy and level of risk. 4. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are similar to mutual funds in that they pool money from multiple investors to buy a diversified portfolio of assets. However, unlike mutual funds, ETFs trade on exchanges like stocks. This means you can buy and sell shares of an ETF throughout the trading day, just like you would with individual stocks. Why it's important? ETFs are popular among beginner investors because they offer the diversification of mutual funds but with more flexibility and lower fees. They can track various sectors, indices, commodities, and even bonds, making them a versatile investment option. Key point: ETFs are generally more cost-effective than mutual funds, as they often have lower management fees and are passively managed. 5. Risk tolerance. Risk tolerance refers to the amount of risk an investor is willing to take on in order to achieve their investment goals. Understanding your own risk tolerance is a crucial step in building an investment strategy. It varies from person to person and is influenced by factors such as age, financial goals, and emotional comfort with market fluctuations. Why it's important? Risk tolerance helps you decide the types of investments that are appropriate for your portfolio. Younger investors may have a higher risk tolerance because they have more time to recover from market downturns, while older investors may prefer safer, income-generating investments as they approach retirement. Key point: risk tolerance can change over time depending on your life circumstances, financial goals, and market conditions. 6. Diversification. Diversification is the practice of spreading investments across different asset classes, industries, and geographic regions to reduce risk. The idea is that by owning a variety of investments, The poor performance of one asset class can be offset by the better performance of others. Why it's important? Diversification is often considered the key to managing risk in an investment portfolio. A well-diversified portfolio is less likely to experience large swings in value because it is not reliant on the performance of a single investment. Key point: diversification does not guarantee a profit or protect against loss, but it can reduce the risk of large losses in your portfolio. 7. Compound interest. Compound interest is the interest on an investment or loan that is calculated based on both the initial principal and the accumulated interest from previous periods. In other words, it's interest on interest. This powerful concept is the key to growing wealth over time, as it allows your investments to grow exponentially. Why it's important? Compound interest can significantly enhance the value of your investments over time. The earlier you start investing, the more time your money has to grow through compounding. For example, if you invest $1,000 at an annual interest rate of 5%, you'll earn interest on both your initial investment and the interest you've already earned. Key point: compound interest is particularly beneficial for long-term investors, as it allows small investments to grow into significant amounts over time. 8. Asset allocation. Asset allocation refers to how you distribute your investments across different asset classes, such as stocks, bonds, real estate, and cash. A well-balanced asset allocation is crucial for managing risk and achieving your financial goals. Why it's important? Your asset allocation depends on your risk tolerance, investment goals, and time horizon. For example, a young investor with a long time horizon may have a higher allocation to stocks, while an older investor nearing retirement may shift more of their portfolio into bonds and other lower-risk assets. Key point: asset allocation is a key component of diversification. A well-allocated portfolio helps reduce risk while maximizing potential returns. 9. Capital gains. Capital gains are the profits you earn from the sale of an asset, such as stocks, bonds, or real estate. If you sell an asset for more than you paid for it, the difference is your capital gain. Capital gains can be short-term or long-term, depending on how long you hold the asset before selling. Why it's important? Capital gains are a primary source of income for investors. Understanding how capital gains work is important for tax purposes, as they are subject to taxation. Short-term capital gains, on assets held for less than a year, are typically taxed at a higher rate than long-term capital gains, on assets held for more than a year. Key point: capital gains taxes can significantly impact your investment returns, so it's important to be aware of your holding periods and tax strategies. 10. Dollar cost averaging, DCA. Dollar cost averaging, DCA, is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. This strategy helps smooth out the effects of market volatility and reduces the risk of making large investments at the wrong time. Why it's important? DCA allows you to avoid the stress of trying to time the market. By investing consistently, you purchase more shares when prices are low and fewer shares when prices are high, which helps lower your average cost per share over time. Key point: DCA is a great strategy for long-term investors who want to avoid emotional decision-making and reduce the risk of market timing. Investing doesn't have to be overwhelming, especially if you take the time to understand the key terms and concepts that drive the investment world. By becoming familiar with terms like stocks, bonds, mutual funds, risk tolerance, and compound interest, you will be better equipped to make informed decisions and build a diversified portfolio that aligns with your financial goals. Whether you're just starting out or looking to refine your investing strategy, understanding these 10 key terms is the first step toward becoming a confident investor.